Have you ever wondered what caused the worst economic downturn in the history of the industrialized world? Let's take a journey back to a time of prosperity and exuberance, the Roaring Twenties. The air was brimming with optimism, a sense of invincibility. It was a time when the American economy was on an unprecedented upswing, a time when the stock market became the nation's obsession. The 20s were indeed roaring. The economy was flourishing, and industries were expanding at an incredible pace. The stock market was the star of the show, with stock prices soaring to unimaginable heights. For the first time in history, the stock market was not just for the wealthy elites. It had become a playground for the general public. Everyone, from factory workers to teachers, was trying to get a piece of this lucrative pie. The allure of easy money was irresistible. The stock market seemed like a golden goose, laying eggs of fortune for anyone daring enough to partake. This widespread fascination with the stock market led to an explosion of reckless investments. People were buying stocks on margin, essentially borrowing money to buy more stocks, betting that the prices would continue to rise. This frenzy of investment created a bubble, an artificial inflation of stock prices. The economy was not as strong as it appeared. It was a house of cards, waiting for the slightest gust of wind to bring it all crashing down. The stock market had become disconnected from the real economy. It was fueled by speculation and false optimism rather than solid economic fundamentals. And this was the prelude. The stage was set for one of the most dramatic economic collapses the world had ever seen. The bubble was growing larger and larger, filled with the hot air of false prosperity and unchecked speculation. But bubbles, as we know, are not meant to last forever. And then, seemingly out of nowhere, the bubble burst. October 24, 1929, a date which would forever be known as Black Thursday. As the sun rose on that fateful day, the Wall Street Stock Exchange was abuzz with an air of unease. The seemingly invincible bull market had begun to falter. The first tremors of panic were felt as investors, gripped by fear, started to sell their stocks. It was a snowball effect. The more people sold, the more prices dropped, and the more prices dropped, the more people sold. The trading floor was a cacophony of frantic shouts and desperate pleas as brokers struggled to keep up with the torrent of sell orders. Stocks that were once the darlings of Wall Street were now being discarded like yesterday's news. It was a frenzy of selling unlike anything the market had witnessed before. In a desperate bid to stem the tide, a group of the nation's most powerful bankers convened an emergency meeting. Their plan was simple, yet bold. They would pool their resources and buy large quantities of stocks, hoping their show of confidence would arrest the panic. And for a brief moment, it seemed to work. The market stabilized, the selling slowed, and a collective sigh of relief could be heard across the trading floor. But this was merely the calm before the storm. The respite was short-lived, and the market resumed its downward spiral. The bankers' intervention had been a futile effort. Their attempts to buoy the market were like trying to hold back the ocean with a broom. The sheer volume of selling was too much, and the market plunged even further. Stocks were now worth only a fraction of their peak values, and fortunes were lost in the blink of an eye. As the dust settled on Black Thursday, the magnitude of the crash began to sink in. The bubble that had been the Roaring Twenties had burst, and the fallout was catastrophic. The market was in free fall and the economy stood on the brink of an abyss. But the worst was yet to come. Just 5 days later, the market would face its darkest day. It was October 29, 1929, a day that would forever be etched in history as Black Tuesday. The stock market, once a symbol of prosperity and wealth, was about to crumble in a spectacular fashion. On this fateful day, a whopping 16 million shares were traded on the New York Stock Exchange, an unprecedented volume at the time. The ticker tape machines ran hours behind due to the sheer number of transactions. In the frantic rush to sell stocks, prices plummeted drastically. But why such a rush? Well, it was the sudden realization that the economic boom of the Roaring Twenties was over. The bubble had burst, and people were desperately trying to salvage whatever they could. The optimism that once filled the air was replaced by a palpable sense of panic and despair. Blue chip stocks, which were previously seen as safe investments, were not spared either. They too faced a steep decline in market prices. For instance, U.S. Steel, a leading industrial company, saw its shares drop from a high of $261 to a mere $170. The panic was not confined to Wall Street. It spread across the nation like wildfire. Banks, fearing the worst, began calling in loans, which further exacerbated the situation. People from all walks of life, from the wealthy elite to the average Joe, felt the impact. Life savings were wiped out, fortunes were lost, and dreams were shattered. And the worst part? There was no safety net. No governmental safeguards were in place to prevent such a catastrophe. The government, under President Herbert Hoover, was woefully unprepared for such a financial crisis. In the end, Black Tuesday marked the end of an era. It was the day when the illusion of unending prosperity shattered, giving way to harsh economic realities. And with that, the Great Depression had begun. The crash didn't just affect Wall Street, it sent shockwaves around the world. The 1929 stock market crash was a global catastrophe. Its impact was felt far beyond the bustling streets of New York City. Banks and businesses across the globe collapsed like a deck of cards. In the United States alone, over 9,000 banks failed during the next few years. Millions of people lost their savings as these financial institutions crumbled. Unemployment soared as businesses shuttered their doors. In the early 1930s, it was estimated that nearly 1 in 4 Americans were jobless. That's roughly 25% of the population. People who had once lived comfortable lives were now struggling to put food on the table. The economy spiraled into a deep decline. This period, known as the Great Depression, saw the gross domestic product in America fall by nearly 30%. The global economy wasn't spared either. Countries around the world experienced a similar economic downturn, leading to widespread poverty and distress. The crash and its aftermath were not just about numbers and statistics. They were about people. Ordinary men and women who had to bear the brunt of the crisis. Families were torn apart, dreams were shattered, and lives were irrevocably changed. People stood in soup lines waiting for a meal. Farmers watched helplessly as their crops withered and their lands turned to dust. The once vibrant cities became ghost towns, with vacant buildings and deserted streets. The joy and optimism of the Roaring Twenties were replaced by a sense of despair and hopelessness. In the midst of this economic turmoil, society underwent significant changes. Traditional gender roles were challenged as women sought work to support their families. Social unrest grew, leading to the rise of labor movements and protests. The crash of 1929 was not just an economic event, it was a human tragedy. Its effects were felt for decades, and it left an indelible mark on the world. It was a time of despair, a time of economic hardship. But even in the face of such adversity, the human spirit proved resilient. With the dark days of the 1929 stock market crash still looming large, the nation found itself grappling with an economy in shambles. But, as with all things, change was on the horizon. It was a time of great challenge, but also a time of significant transformation. The government sprang into action, implementing measures to stabilize the economy. The Reconstruction Finance Corporation was established, injecting much-needed capital into banks, railroads, and other key industries. A series of public works programs were launched, creating jobs and stimulating economic growth. Regulatory reform was another critical piece of the puzzle. The introduction of the Glass-Steagall Act in 1933 ushered in a new era of banking regulation, separating commercial and investment banking to prevent the risky speculation that led to the crash. The Securities and Exchange Commission was also established, tasked with regulating the stock market and protecting investors. The recovery was slow, painstaking work. It was a time of trial and error, of learning and adapting, but with each passing year, the economy began to regain its footing. Businesses slowly started to bounce back, jobs began to reappear, and consumer confidence gradually started to return. The lessons learned from the crash were invaluable. It was a wake-up call, a stark reminder of the dangers of unchecked speculation and economic imbalances. It underscored the importance of sound financial practices, robust regulatory frameworks, and economic diversity. The crash of 1929 was a harsh lesson, but it was a lesson learned. It shaped the future of financial markets and regulatory structures, providing a blueprint for how to prevent such a disaster from happening again. The recovery from the 1929 stock market crash was not just about economic resilience. It was about the resilience of the human spirit, the ability to adapt and overcome in the face of adversity. The 1929 stock market crash was a harsh reminder of the dangers of unchecked speculation and economic imbalances. So, what can we learn from the 1929 stock market crash? The 1929 stock market crash, often referred to as the Great Crash, is an event that has left an indelible mark on our collective financial history. It serves as a stark reminder of the cyclical nature of economies and the potential fragility of financial systems. In the Roaring Twenties, the United States experienced an economic boom like never before. The prosperity was palpable, and the stock market became the playground of not just the affluent, but also the common man. This widespread speculation led to the formation of a stock market bubble, a bubble that was destined to burst. And burst it did. On that fateful day, Black Tuesday, panic selling gripped Wall Street. Investors scrambled to sell their stocks, leading to a catastrophic drop in prices. The ripple effects of this crash were felt not just in America but across the globe, ushering in the Great Depression. The aftermath was brutal. Unemployment rates soared, businesses shuttered, and countless lives were thrown into disarray. It was a period of immense hardship, but it was also a period of learning and growth. The country eventually found its footing and embarked on a path of recovery, albeit a slow and arduous one. If there's one key takeaway from the 1929 stock market crash, it's the importance of financial literacy and prudent investment. It underscores the need to understand the risks associated with investing and the necessity of diversifying one's portfolio. It also highlights the value of regulation in maintaining the balance and stability of our financial systems. As we navigate our own economic challenges today, the lessons from 1929 continue to echo, reminding us of the importance of balance, caution, and resilience. The Great Crash serves as a poignant reminder that while markets may rise and fall, our ability to learn from the past and adapt for the future is what truly defines our economic journey. As we navigate our own economic challenges today, the lessons from 1929 continue to echo, reminding us of the importance of balance, caution, and resilience.